Money. It began as a promise that what you give today will still have value tomorrow. But that promise needed trust, and trust needed a keeper. That's how banks were born, not as buildings, but as ideas that shape the world we live in today. Let's go back, thousands of years ago, to a time before ATMs, credit cards, or even coins. In ancient Mesopotamia, farmers stored their grains in temple vaults. The priests kept records, clay tablets with marks showing who owned what. Those temples became the first banks. They didn't lend money, they lent trust. Centuries passed. As trade grew, people needed something easier than carrying sacks of grain or chunks of gold. In ancient Greece and Rome, merchant changers appeared, men who exchanged foreign coins, kept them safe, and lent them at interest. That simple idea, lending for profit, was the seed of modern banking. But as trade routes stretched across continents, a new need was born: safety. Merchants carrying gold across deserts and seas risked everything: pirates, bandits, storms. So they started depositing their gold with trusted goldsmiths. The goldsmiths issued paper receipts, proof that gold was stored safely. These receipts could be traded, passed from one hand to another. And soon people realized something revolutionary. The paper itself had value. Money had just gone from metal to paper. By the 14th century, in the bustling cities of Florence and Venice, a new kind of business rose: the merchant banks. Families like the Medici turned money into empire. They financed kings, funded wars, and created double-entry bookkeeping, the very foundation of modern accounting. Every coin that moved was written twice, debit and credit, ensuring accuracy, transparency, and trust. The Medici name became synonymous with wealth, power, and innovation. They didn't just store money, they created it. But banking was never just numbers. It was power, and power invites conflict. In medieval Europe, lending money at interest was seen as sinful, usury, forbidden by the church. Yet commerce demanded credit, so Jewish merchants and foreign traders filled the gap, quietly shaping the system from the shadows. Over time, necessity changed morality. What was once sin became business. Then came the 17th century, the birth of modern central banking. In 1694, the Bank of England was established to finance war against France. Investors gave money to the government. In return, they received banknotes, promises to pay gold later. Those notes became the first true paper currency, backed by the state. The idea spread like wildfire. Sweden, the Netherlands, and France followed. Banks no longer just kept money. They created it through loans, credit, and confidence. But with creation came chaos. When banks lent too much and people lost faith, panic erupted. Depositors rushed to withdraw money that didn't exist. The first banking crisis were born. The system that promised stability could collapse overnight, not because gold disappeared, but because trust did. In America, this cycle repeated again and again. From the Panic of 1837 to the Great Depression of 1929, each collapse taught the same painful lesson: money is only as strong as the belief behind it. That's why in 1913, the U.S. created the Federal Reserve, a central bank designed to protect the nation's financial system, control inflation, and act as a lender of last resort. It was the beginning of government-controlled finance, a new balance between freedom and regulation. But war once again reshaped everything. During World War II, nations borrowed beyond imagination. After 1945, the Bretton Woods Agreement tied world currencies to the U.S. dollar, and the dollar to gold. America became the banker of the world. Banks flourished. Credit cards were invented. Loans built homes, cars, and dreams. The middle class was born, powered by borrowed money. Yet in 1971, something historic happened. President Richard Nixon ended the gold standard. The dollar was no longer backed by gold. Money became fiat, value by government decree. The paper in your hand was worth something only because everyone agreed it was. The system shifted from tangible wealth to faith, pure trust, and banks became the priests of this invisible religion. From then on, the world changed faster than ever. Banks grew into giants. They no longer just held savings. They ruled investment, real estate, and global trade. The 1980s and 90s brought deregulation, globalization, and digitalization. Money moved at the speed of light. Computers replaced ledgers. Credit replaced cash. And ordinary people became players in a game once reserved for kings. But every rise brings a shadow. In 2008, the system cracked again. Greedy lending, reckless speculation, and blind trust led to the global financial crisis. Banks too big to fail almost did. Millions lost their homes, jobs, and savings. Governments bailed out the institutions that caused the disaster, printing trillions to save the system. And once again, ordinary people paid the price. Still, humanity didn't stop. From those ashes rose a new revolution: digital banking and cryptocurrency. No more waiting in lines or signing papers. Money became code. Bitcoin promised freedom from banks, transparency from corruption, and control for the people.
But even digital money depended on belief, a belief in algorithms instead of governments. Today, banks no longer just live in cities, they live in your pocket. With one tap, you can transfer money across oceans. Artificial intelligence predicts markets, algorithms decide loans. But the heart of banking hasn't changed. It still runs on one thing: trust. From clay tablets in Mesopotamia to blockchain ledgers on the internet, the story has always been the same: how to move value safely between strangers. And behind every transaction, behind every number on a screen, there's a story of a farmer saving for his child, a mother sending money home, a dreamer starting a business, a nation rising or falling. The banking system didn't just rise, it evolved with humanity. It built cities, funded empires, caused wars, ended poverty, and created wealth. But it also created inequality, greed, and control. It gave us convenience and dependence, security and surveillance. Maybe that's the paradox of progress. Every solution comes with a price. The same system that lifted billions out of poverty can also enslave them in debt. The same trust that built empires can destroy them overnight. So as we swipe, tap, and transfer our way through the digital age, perhaps the question isn't how banks rose, but whether we still control them or they control us. Because in the end, the rise of the banking system is not just about money. It's about faith, in numbers, in promises, and in ourselves.